Thank you, everybody, for being here. Welcome again to TokenizeThis by STM.co. Really, really happy to have a full crowd here in New York City after the event last year in Miami, Florida. My name is Kyle Sonlin. I am an alumni of the STM team. I worked on STM in the launch with Herwig and Jason and Callie and everybody here. So really happy to have everybody in attendance. And we have a great panel today talking about multi-chain interoperability for real-world assets. And from my perspective, these are real things. These are ownership in companies, in real estate, in commodities, in stablecoins, as we heard from our previous panel. And in the traditional financial markets, they don't worry as much around what technology backs a dollar that gets sent from one bank to another, or one stock from one bank to a different bank. And so this isn't necessarily something that you might think about in a traditional space, but in the blockchain sector, there are more considerations to think about from these things, and I think that we're gonna have a really fun panel today. So before we kick into that, I wanna start all the way on the opposite side with Nick. Maybe introduce yourself, and we'll go from there.
Sure. Hey, everybody. Nice to see you all. My name is Nick Ducoff. I'm head of institutional growth at the Solana Foundation.
Hi, all. It's a pleasure to be here. My name is Olivia Vande. I'm on the institutions and capital markets growth team at Labs, which supports the Avalanche blockchain.
Hi, everybody. My name is Colin Butler. I am global head of institutional capital at Movement Labs, formerly of Polygon Labs, as many of you probably know from my prior life.
Hey everyone, my name is Jack Bronson. I'm head of partnerships at Redbelly Network.
So I want to start maybe with, we've seen a ton of activity in the Solana ecosystem this cycle with everything from crypto to meme coins, that style of adoption, and they're continuing to expand into the real-world asset ecosystem. Could you talk a little bit about your perspective as one of the largest market leaders in the L1 industry around interoperability with other platforms, other tech companies, and the like?
Sure. So just to kind of set the stage a little bit, Solana has around 100 million daily transactions, 5 million daily active wallets. We just hit 13 billion in stablecoins, 7 of which have over 100 million TVL. So I think we continue to see more utilization of the network, and the network is getting better and faster. It's currently 65,000 TPS, and Jump Crypto, the trading firm, is building an independent validator client called Firedancer, which will increase that to 1 million. And so I think that with internet capital markets, trading wants to happen in a single venue. And so what you see with interoperability is both the assets and the capital want to move to a single chain. And we're seeing that with assets that may start on one chain and bridge over to Solana and then trade on Solana, even if then capital bridges somewhere else to off-ramp or settle, if an asset might be on a private network like an Avalanche subnet or something like that. So I think we're still early overall in this industry. The joke is still early, but I really do believe we're like bottom of the first, maybe top of the second. So there's a lot of room to grow for all of us.
It's a really interesting perspective. And so maybe kicking up the conversation over to Olivia, from your perspective, from interoperability, we talked a little bit before behind the scenes around, I see at least 3 ways we could talk about interoperability. One being between the actual blockchain infrastructures themselves, one being between the types of customers that may interact with a real-world asset, whether it's retail, the average person that buys on a Robinhood or on a Coinbase, versus a high net worth or family office, something like that, and then obviously institutional or enterprise capital. And all 3 have very different perspectives. And we also have interoperability between asset classes, whether it's real estate, equities, commodities. What's your thoughts on which one is the most important for Avalanche moving forward?
Yeah, absolutely. So for context, Avalanche is a network of layer 1 blockchains that are customizable for any use case, be it gaming with the launch of the AAA-rated gaming studios game called Off the Grid, or DeFi protocols such as Aave, Benki, DEXs such as Faro, DPIN, AI, and of course institutions and capital markets where I sit. So there's a wide gamut of use cases across asset classes and across industry verticals and all of these entities can build layer 1 blockchains according to their needs, industry requirements, et cetera. Where I get very excited is regardless of whether you're a retail user or high net worth individual, or if you're using a DEX on Avalanche, or if you're in the trenches of the off the grid game, there is now native interoperability between these layer 1 blockchains and projects within the Avalanche ecosystem, which means that through a mechanism called interchain messaging, without getting terribly technical, it enables there to be the native passage of assets, messages, data, oracle feeds without third-party trust assumptions, or namely bridges. Of course, we do integrate with those, and there are different interoperability systems like Chainlink, CCIP, Layer 0, Axelar, et cetera. But as of our network upgrade in December, there's now this really exciting unlock to connect the high net worth individuals, retail users, across asset classes, across different industry verticals, with this native interoperability function, and without the risks that come, with the third-party trust assumptions and bridges.
And so that interoperability function is specifically for the layer 1s that are within the Avalanche umbrella, or how does that work with external partners as well?
So for the moment, it is within the Avalanche ecosystem. It leverages our P-chain, essentially our registry of validators and their keys. And so it is within the Avalanche ecosystem using the 2 known and trusted validator sets from layer 1 to layer 1. We have our Avalanche C-chain, which is a more general purpose liquidity hub, as I would call it. So you can easily, with native interoperability, securely move assets from the C-chain to an L1, from an L1 to an L1, wherever the assets, messages, et cetera, need to go.
So I think this is a really fun panel and group of panelists here, because we have Solana and Avalanche, which are the big players on the block. They've been around for quite some time. And then we have some of the newer entrants into the market. And I mean that in a really positive way. A lot of times you see second mover advantage being a tremendous opportunity in technology. And so I wanted to go over to Colin. Colin, what's your perspective on interoperability, whether it's with existing blockchains? Is that something that you think is just going to be solved in the future and it's not the main focus of your business? Or is this a really key component to bootstrapping that initial liquidity and growing the marketplace?
Yeah, I think movement is new enough that it probably needs an introduction even to the concept, probably as Redbelly will as well. As Nick was alluding to, we are super, super early in product market fit for this industry. Going through the last 3 years at Polygon, I mean, I remember the day that Polygon flipped Solana and we're like, Ethereum is going to be a very dominant technology. And now, Nick's about to come out with FireDancer at 1 million TPS. And it's just a very different world. A year from now, 2 years from now, it's also going to be a very, very different world. I think from us that have been in this industry for a long time, that's all we really know, is that tomorrow is going to be very different than today. So movement was really founded around the idea that Solidity is not as secure and not as scalable as is needed to build a new global financial system. It has 85% market share currently. But when Facebook went to build a global payment system with the Libra project, they realized that the blockchain as it stood didn't have what was needed. And so they purpose-built a new chain from the ground up, spent about $1 billion over multiple years to create a new language called Move. And so the core idea is that when new developers come into this space, they're going to look at the different languages and they're going to choose one that's much easier to build on and much more secure in general. And that's going to be a choice for them. So the 85% market share potentially changes. Maybe it goes to 50%. Maybe over time it goes to less. I think when I started, it was very clear to everybody that Ethereum was going to be a global settlement layer. It was the most used. It had the Lindy effect. It was a clear winner. And I think that that's largely in doubt. I mean, based on what the other folks on this panel are doing. And so as we lean into that idea, it's an experiment, right? We don't know for sure what's going to happen, but we believe that the Move language could take a lot of share in the future. Now, how does that affect FireDancer, right? It's like, wow, Nick's going to say, listen, I have 1 million TPS, And that is, man, that's amazing. What if he gets installed at 5% of the banking system? How does it affect all the other chains? Well, the people that are in Indonesia and Turkey, where Movement happens to have large communities, they're building different products. I'm sure they would love to connect to Nick's liquidity. And they're going to build on Movement because it's easier for them. They don't need a fraction of the TPS and the robustness of what Nick is offering. But they would love to connect to that global ecosystem. And so as I do think interoperability gets solved through the technology, I think it's absolutely necessary because there's just different use cases for all these chains. And I do think that by pooling the liquidity together, that's ultimately how you see industry product market fit.
Yeah, you said something that maybe you wanted to jump in, but I'm also, if you want to
Yeah,
first.
no, I agree with what Colin said. I think we think about it as like 3 layers. The bottom layer is the blockchain itself, and I think, to some extent, we were talking yesterday about if blockchain, block space is commoditized. There's the blockchain part of the stack. There's the tech part of the stack, which is Colin talked about with Move. And this is, I think, developer experience as well as user experience, which are both important, right? You want to attract the best builders into your ecosystem. You want to make it very easy for them to build, as Colin was saying. You also want to make your technology as delightful of a UI as possible so that customers love it, right? And then the third part of this is the economy and the ecosystem. And I think, one thing I've talked to Olivia's colleague Morgan about is, each one of these blockchains has different ecosystems and economies. Each one has different technology. And then, the block space is, block space, I think ours is better, but it doesn't matter. It's very important, I think, to keep going up the stack. Better tech, and specific customer fit with your ecosystem that you're trying to build.
Yeah, I wanted to double tap you on that, though, because something that Colin said was interesting, and I want to hear your perspective. And so for a lot of companies or banks that might be considering using tokenization, liquidity is this, holy grail question mark. And clearly Solana has a ton of activity and a ton of liquidity on the retail side. What's your perspective, and what are the strategies around bringing that liquidity, that activity, that trading volume into the RWA ecosystem? Is that something that you feel like you have some level of control over by being the technology provider of the whole ecosystem? Or is that something that's more consumer driven and there's this invisible hand that will move that liquidity naturally, provided that you create those bridges to do it?
Yeah, I think the latter. I mean, I think the beautiful part about building a thriving ecosystem and having composability, within the blockchain with DeFi is that, incredible founders can build delightful applications to make it wonderful to trade tokens, right? And we're going to hear from Nathan from Orca, I think, later today about this, but I'm sure it's the same within Avalanche. I'm sure it's the same within Movement. The DeFi protocols are very motivated to find ways to allow for RWAs to sit alongside digital assets, right? And I think the customer, whether it be institutional or retail, ultimately wants to be able to trade all these things together, right? To be able to trade Tesla against, Jupe, which is the native Jupyter governance token. And I think that's going to happen because of the consumer pull for it. And you need the liquidity, but today's liquidity, even on Ethereum mainnet isn't enough to handle the type of trading volume I think we all hope to see in inning 4, 5, 6 as this really grows from billions to trillions.
I would also add, of course, retail demand is a pivotal piece of this, but also institutional push is critical, and integrating within robust existing distribution channels where there already exists a loyal user base that trusts institutions like the Citis or JP Morgans of the world that we've worked with. That requires also entities that are taking a very concerted B2B2C approach. So they're not direct to consumer necessarily, but folks like OpenTrade, for example, or the Denaris of the world that are taking a B2B2C approach to collaborating with fintechs and neobanks and these platforms that already have existing distribution channels with retail, and where they can offer things like tokenized US equities or access to USD or the ability to earn yield on USD. Those, I would argue that, yes, of course, retail push is important, but then there's also consensus and push by the institutions who are able to offer these amenities, to retail in the first place.
So I want to kick it over to Jack. We haven't heard from you yet. Could you talk to me a little bit more about your perspectives on layer one blockchains and what differentiators there are, why interoperability might matter from your perspective, and how Redbelly approaches the go-to-market and tokenization?
Yeah, absolutely. And as you alluded to earlier, everyone here is probably very familiar with Redbelly Network. But for those that aren't, it's a new-ish layer one that's solely focused on RWAs. So, Solana has a bunch of different use cases. So does Avalanche, Movement as well, right? We are solely focused on tokenized assets and bringing those assets on chain, making it very easy for asset issuers to put those primitives on and do a primary issuance. When it comes to interoperability, I think, Olivia, what you were discussing earlier about just how these different chains can talk to each other. Listen, when it comes to new financial products, they're going to go where there's liquidity. And what it makes the most sense for an issuer is to take a multi-chain approach. The future is 100% multi-chain. We've done things like create an EVM compatibility layer to make it really easy for devs to develop on it, to make it very easy for these assets to compose and go to different chains. But at the end of the day, we want asset issuers to have their home chain on Redbelly, or have Redbelly be their home chain, and then the assets can go where the liquidity is.
So what does a home chain constitute? Like, what does that provide to an issuer that either doesn't exist in the traditional solutions, or why is that valuable for them to work directly with a firm that's more flexible or mobile to do so?
Totally. Well, Redbelly, for example, right? What we do and what we provide for asset issuers, we KYC at the network level, because frankly, it's a pretty big jump to take your business that's operating in the financial sector to go from an off-chain on AWS to on-chain, right? And then that requires on some different layer ones, a number of partners, a number of kind of crypto literacy in order to figure out those hurdles. Our goal is to make that extremely, extremely easy. And so, yeah, I mean, when it comes to what the benefit is of working directly with a chain is everyone's going to have different business needs and different reasons for going on chain. And so finding the right partner that can help you on that journey, depending on what your goals are, I think is really important.
Sure. No, I think that makes a lot of sense. And compliance is really, really important here when we're talking about real-world assets. So, maybe going over to you, Nick, like, how do you work with the financial services players in order to enforce these things? And maybe if any other ideas around that topic. That's, I think, a big key piece of interoperation here is actually connecting with the traditional players that enforce the compliance requirements on behalf of accredited investors or institutions or counterparties that are involved in a transaction.
Sure. So building on what Jack said about like KYC as an example, in January, there was a meme coin launched on Solana that drove quite a lot of activity around January 20. And MoonPay, so Jupiter, which is a large DEX on Solana, has an app called Moonshot, which is you can easily on-ramp fiat and trade meme coins. MoonPay is who Moonshot uses to KYC customers coming into that app with fiat and then off-ramping it. In a single day, they KYC'd 3 million customers, right? So I think that going back to, blockchain, block space, technology, economy, ecosystem, you want to build a vibrant and thriving group of people building, protocols, applications, and tokens across that whole stack. And I think the future is multi-chain. There are various benefits to different blockchains and different technologies, and I think that ultimately folks will go where the liquidity is.
So if the future is multi-chain, how do you think that looks? I mean, with my business, Global Settlement, a lot of what we've dealt with from a cross-chain interoperability perspective is that banks, institutions, or mostly buy-side that we engage with, they're uncomfortable with bridges. Because it seems like every crypto hack that anybody in the audience has heard about usually comes from bridge funds, where these get locked up in these little contracts, and then you have a bad actor that figures out how to hack into those things. So what does that look like from your perspective in terms of being multi-chain compatible? Is bridging the future? Do we need to upgrade that technology, or is it something totally different?
I have a lot of thoughts on this, but I think I'd like to hear Colin, maybe wearing your Polygon hat, AgLayer, like where you all were going with that and how you think about it.
Yeah, thanks, Nick, for teeing that up. Actually, I have a lot of thoughts. There's a product that Polygon's been working for some time using zero-knowledge technology that essentially creates cross-chain transactions in under a second without taking bridge risk. Bridge risk is a huge, huge issue. In a future state, near future state, you could take liquidity that you have on Solana and do a DEX transaction on an Avalanche-based DEX in under a second and have it look more like the current internet today, where it's one click, you don't even know you're going cross-chain. So it's the user experience that looks much more like Web 2, and we're no longer even talking about bridge risk and hacks and things like that. And that product has been something that has been in the works, and it's about really to go, I think, mainstream in the very, very near future. So that might obviate some of the conversation here.
I also wanted to add that back to your original question, just from an institutional perspective, another piece that's quite important is, I think we're at this TCP/IP moment, if you will, whereby there's consensus and standardization occurring, be it at standardization of identity level, be it at the token standard level with standards such as ERC 3643 or ERC 1400 that are focused on permission tokens. There's this moment that we're coming to whereby the institutions and other industry players are coming together to come to a consensus on, what does custody or what does finality mean? Do we have a standard definition of it? That can be difficult across bridges from a legal perspective, so there also needs to be some legal consensus to be had. But I think we're trending in the right direction of this TCP, IP moment or standardization moment that's critical for institutions to really wrap their heads around.
Yeah, I think it's a good point. And Nick, you totally, I love your analogy of using the blockchain, technology, economy, ecosystem stack, because something, Olivia, when I was with STM and we were doing our tokenized crowdfund, which some of the OGs in the audience may remember, we ended up working with Avalanche as a partner and Securitize as our underlying broker-dealer. And one of the big constraints for us was actually we wanted to use MetaMask, because we were targeting retail investors, and this is a few years ago when Solana was slightly less retail active. And so for us, it was like, look, it just needs to be MetaMask compatible. We feel like most people have that extension on their computer, and so as long as it has that capability, we're probably going to be okay. And so that kind of app layer, it could potentially, especially from a retail perspective, maybe for institutional capital, they're going to be building custom integrations and things like that. They've got more tech resources, but certainly from a retail opportunity side, what you're talking about, where it's a click of a button on an application layer, the retail may never even be interested in knowing what the actual underlying tech is to power those things. Like, does anybody care that Plaid is the provider when you connect your bank account? No, I just want to put my credentials in and move forward. So I think that what you're saying makes a lot of sense there. And so I guess from your perspective, Jack, operating in Australia and some of the other jurisdictions, how do you approach interoperability between the U.S. markets or the Southeast Asian markets or the all of the local regions inside and outside of kind of your home base?
Yeah, so how we approach that is really working directly with our partners to provide a comprehensive ecosystem to navigate the different geographic boundaries. right? And so, like, as we all know, the US is extremely siloed when it comes to tokenized assets and securities. We don't have a robust regulatory framework. The predominant ones now that we've seen in practice are the Singapore MAS and the Swiss DLTA. And so now folks that adhere to those guidelines, it generally is pretty easy to take a global approach, sans the US. And so we kind of partition these asset issuers into, well, are you licensed for distribution into a global market, US market, or both? Securitize has predominantly a relatively large moat. I think that's coming down when it comes to access to the US market and tokenized assets. But a lot of what we're seeing is actually what Olivia said, is a B2B2C approach, whether that's using DeFi tooling. I believe in the last panel they mentioned vaults as a solution, liquid restaking of stablecoins. I think that's all really interesting. I think when it comes to retail demand, we have yet to fully see that flesh out. And I think partially that's because DeFi is great in crowdsourcing creativity for new financial products, right? But these primitives, well, if you think of these assets like Wisdom Tree's money market fund or their S&P 500 fund, for example, if you look at them as primitives for DeFi to build new financial products on top of, they will figure out a way that makes it attractive to them. But when it comes to institutions, primary issuances of new products on chain, things like tokenized receivables, things like we just launched a titanium product with Raise Finance. But things like that, I can see institutional demand, but they need to realize the cost benefit of tokenization, which, as it stands right now, it's pretty expensive to go from doing business off-chain, doing it on AWS, normal servers. There's a very clear path to how to raise capital for some of these assets. Whereas on-chain, it's a bit more complicated. There's switching costs for all of these systems. And so how do we generate the most promising assets and primitives so that then DeFi can come in?
So Colin, you've moved from Polygon into Movement and are building out this institutional arm of Movement's product stack. What's your perspective on Jack's views there? Like if this does have an onboarding cost associated with changing the process, and if the market is still growing and we're in inning one, as Nick described it from an analogy perspective, like what is the process for onboarding institutions? Like how would somebody that's in the crowd today or watching online who is this for?
I think the onboarding costs can be considered upfront costs, sunk costs, one time to get into just it's really a paradigm shift for a way of transmitting data. So I'm less concerned about that. I think who is it for is a very important question. Jack mentioned receivables as one use case, and that's another thing. I don't think Nick has a ton of time to fly to Australia to work with APAC banks on receivables. Right? We don't, literally the people up on this stage don't have the time to cover all these ideas, and they're all gigantic ideas. What I do think is that if you can take, for instance, the core early constituency of Movement Labs in non-US jurisdictions and bring highly credible US-based institutional RWA products to those markets, sometimes through vaults, so in a permissionless format, that is a product for which there just was no prior product. Or maybe I put it this way. It's an order of magnitude better solution than the prior solution, which is, personally, I think, one of the main definitions for technological disruption. If you have kind of like a 10x better, I think that's what call it institutional product to the 1.9 billion people in the world that are unbanked, or the people, essentially all the people outside of the US and Europe that are underserved by the financial markets. I think now for the first time we really have a highly credible attempt at connecting those two by bringing the core large BlackRock level credibility to markets that could really use that.
Yeah, it's an interesting point. I know that a lot of the work that I've been doing with global settlement, we do a lot of trade financing and we work with a lot of stablecoins. And part of the argument around using stablecoins is that the turnover rate is much higher. You can complete a transaction much quicker because of the fact that the actual time it takes to send the money from one place to another is drastically sped up. And because it's sped up so significantly, I can do more transactions with that same dollar because I don't have to have it be waiting in transit so many days, especially when we're talking about international payments from jurisdiction to jurisdiction or from Asia to Africa to Middle East to America. That you're probably ended up crossing 10 banks in order to get that, if not more. And of course, each one of those is going to have their own processes of moving that. So Nick, you guys do a ton of work with stablecoins. And that's clearly the hot topic these days with stablecoins and treasuries and yield-bearing stables, as we heard with our last panel. What's your perspective on stablecoin adoption and how that, that may or may not be correlated with actual RWA growth, just because it's easier to transact in this system, which maybe helps offset some of the costs because maybe it's more profitable or less costly in the long run?
That's a great question. I first want to address something that Jack said. He brought up the fact that the US is typically excluded from a lot of these RWA that are issued out of Singapore or out of the UAE or wherever. One way that issuers are approaching this is they're issuing two tokens. Like Franklin Templeton, for example, has US Benji and Global Benji on Solana and some other chains. The Global Benji is for folks outside of the U.S. The U.S. Benji is pursuant to a public registration statement available to U.S. Investors. So that's one way to approach it. I also think one thing that Franklin Templeton in particular is doing interesting related to what you just talked about is intraday dividends. So if you hold Benji for 4 hours during a 24-hour period, you'll get the yield for those 4 hours of 365 times 7 times 24 or whatever that denominator is. And I think that's incredible when you think about how folks, institutions like Franklin Templeton, like BlackRock, like Wellington, like a number of others that are building on Solana and some other chains are bringing the US dollar plus yield around the world, right? And there's tons of demand for it. I think that is why RWA has seen so much product fit with stablecoins first. The NIM was being captured by the issuer to date, right, by Tether or Circle or whoever, but increasingly that yield is being passed along in some way, either to the protocols that are enabling that utilization of stablecoins. So like Agora, for example, passes yield through to the middlemen, so to speak, or the money fund products like the Benjis, Biddles, et cetera, that are passing it directly to the end holder, and many derivative products, right, like SBiddle, et cetera, that can be a bit more permissionless in nature to be able to be held by folks in Indonesia or anywhere else in the world.
Any thoughts there?
I would just piggyback on that, broadening out from stable coins. I think it's become abundantly clear, starting with stable coins, that there's product market fit there, but then also what can you do with these static tokenized assets gets really exciting. And I think institutions and retail alike will increasingly not only have access to, be it from regulations changing or just new tech being available, but they'll the yields will be so compelling that they can't refuse them. And so one example that I think about is a protocol like Euler or Euler, depending on how you pronounce it, that has recently launched on Avalanche and gives the access to customized lending markets. So it's a borrow-lend protocol that's decentralized, but they have a very unique feature in that they're offering these customized lending markets that can be permissionless, or you can create customized RWA markets that are permissioned. As we see more of those opportunities become available, the yields will just be too compelling. Like when you stack all the yields together, there will be no other answer but to take these tokenized assets and put them to work. And by the way, in 5 to 10 years' time, I think we'll just be calling them assets. They'll just happen to be tokenized. But they have all of these compelling features, like you mentioned, with intraday liquidity, daily dividend accrual, et cetera.
And I would say also like borrowing, right? Like, so to borrow against your brokerage, assets, you tend to have a fairly high amount of assets, in your Fidelity or Schwab or whatever account. On the blockchain with DeFi, since anyone can be a lender, the bar is way lower. And so I did a fireside chat with Christine Moy from Apollo yesterday, and one of the things we were talking about is they have a product on Solana called ACRED, which is a private credit product that has like a 9% yield. That's a nice fat yield. And they're talking to some DeFi protocols in the Solana ecosystem to loop it, right? What if you could very easily, borrow, say, 50, 60% and reinvest? Now that 9% goes to like 13%, right? I mean, I don't know how many times we want to loop it, because then you start to have to manage your collateral. But if you can have a high quality RWA that's yielding 13% in USD denominated yield, that's a product that's going to have tons of demand.
Yeah, it's a fascinating question for me around, and we've got 3.5 minutes left. So, on that point, does liquidity, is that the last bastion of non-interoperable features for blockchains? Like, is this naturally going to be kind of a hold your chips? Because, I've heard a few times in different ways, an asset's going to move to the most liquid chain or these types of things. Do we see liquidity kind of being the thing that everybody competes over? Or is there a way to kind of democratize that, or to create a more fair system where liquidity moves to where the best deals are, or something different that I'm not considering?
I think it comes down to, it will be a chips on the table scenario, but we want to avoid that at all costs. And the way to do that in the most sustainable and productive way is going to be creating new products that don't exist. And by new products, it's either products that are hard to access. Like, let's say in India, for example, it's relatively hard to access the S&P 500. You have to go through a lot of steps and things like that. And that's why I think lending, that Nick mentioned, is probably one of the best use cases of RWAs. If I was going to buy a tokenized house, right, getting a HELOC is on top of that is a pretty long process, requires a lot of paperwork, and then when you get into kind of even less liquid assets than real estate, it's like that's a new net beneficial product to an end user, right? And if we continue to innovate in that way, creating structured products, that's a big, big goal of ours, right? Creating, Bitcoin and different baskets of RWAs alongside of it. So.
Cool. Well, Colin, throw in your final thoughts here. We've got 1.5 minutes left.
Yeah, I guess final thoughts. If you think of crypto as a game of network effects, which I personally believe it is, it makes a lot of sense for all of us to combine liquidity. Like, if we have a unique and novel product on Redbelly, and Olivia has liquidity on Avalanche, it's a huge thing for the Avalanche users. It makes Avalanche much more productive to be able to access the products that are on all of these different chains. So, if you think there's 8 billion people in the world, and we as an industry have penetrated just a tiny, tiny fraction of those, I think we're all going to win by growing a bigger pie.
Yeah, well, I guess the global sum is better, or I guess the total is better than the sum of its parts in that regard. It makes a lot of sense. And maybe from risk mitigation perspective as well, right? When a big notable blockchain or solution inside of this ecosystem, as we've seen across bear markets, when these companies go down, it does impact everybody as well. So it is in our best interest not only to root out bad actors, but to support each other, especially in this small system, because of the fact that I think a rising tide does lift all ships. So any other final thoughts from the panel before we wrap up here?
Excited to see across all chains, tokenization becomes so boring that it's commonplace and abstracted away that we no longer talk about tokenized assets. They're just assets that have all these compelling features and novel use cases.
All right, well, on behalf of my panel and security token market, we thank everybody for being here. Please give a round of applause to our wonderful panelists.